Hi, everyone. This is Jason Bjark of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He has over 30 years experience working in the oil and natural gas industry. He's also one of the top paid investment newsletter writers covering a lot of oil and natural gas stocks, the large cap producers, the mid-tier producers, and also an energy and income portfolio with these master limited partnerships and pipeline companies. Robert Rapier, thank you for joining me again.
Thank you for having me, Jason.
So, Robert, last week at the end of January, we're recording this interview on February 7th, 2023. By the way, for our listeners out there, you put out a piece on your Forbes column about your predictions for 2023. You think that oil prices are going to be substantially lower. Oil stocks are not going to be the top performers for the first time in 3 years. And you think that natural gas prices will be substantially lower. Does that jive, though? In the last 10 days, we saw Schlumberger announce some really interesting earnings on their earnings call, and they said that they're going to be raising prices substantially for drilling costs. So what do you think that means for the oil industry if you're predicting lower oil and natural gas prices, and then the oil service companies that are drilling the wells, and you're predicting a big increase in U.S. oil production? What does that mean then if the prices to drill the wells and the costs are going to be going up?
Right. So a lot of it hinges on two things. One is what happens in Russia and Ukraine, and the other is what happens with the Strategic Petroleum Reserve. The fact is we have a substantially depleted Strategic Petroleum Reserve now relative to a year ago. And if that gets refilled, that's going to put upward pressure on prices. If the war in Ukraine continues, that's going to put upward pressure on prices. I can see some inflation in the oilfield service providers. Oil companies are still making pretty good money, but I don't think they're going to make as good of money this year as they did last year. I think the average prices will be lower than they were a year ago, and that's going to be reflected in the stock prices. I mean, I think at the end of the year, most of the oil companies were a little bit overpriced, and they have pulled back. In January, the energy sector pulled back, and it was one of the worst performing sectors to start off the year. And I don't know that the sector will be down this year, but I don't think it'll match. It's been the top sector 2 years in a row. I don't think it's going to do that again. I don't even know that it'll match the S&P 500 this year, although it should probably still do okay. It just won't be like the last couple of years that we've expected.
So the WTI crude oil price is at 77. The Brent crude price is at $83.65. It's been kind of surprising seeing how the top performers in the oil sector the last couple months are actually, well, obviously Chevron and ExxonMobil are some of the top ones. There's money hiding there, but that's not a surprise because they're increasing dividends. They're doing share buybacks, despite what the Biden administration, the European Union are trying to force them to allocate more capital to ESG. And Biden is strongly telling them, and you also put out an article on this, telling ExxonMobil and Chevron they should not be buying back shares or increasing dividends in this type of environment. But are you surprised that we're seeing the deep water companies like Transocean and others, they're starting to get a lot of business for production growth and new wells, deep water offshore, despite the oil prices being relatively weak lately and kind of range bound?
Well, but think about where they are. I mean, oil prices are still substantially higher than they were just a few years ago. We've kind of gotten used to. We don't maybe think about oil prices went up over $100 last year, and they pulled back to 70 or so now. But oil companies can make money at $40 oil. There's
Chevron, the low cost producers, right? So not every oil company is making money at $40. The low cost guys. So you're maybe
right.
ConocoPhillips and Chevron, EOG, a small percentage.
Right. They will have incentive to drill a lot here at $70 oil. But some of the marginal projects, and this is the point that I made about Chevron getting heat for their stock buybacks. Said, we allow companies to issue shares. Why wouldn't we allow them to buy them back if they don't think the market conditions are the market is reflecting the value that they think is in their stock? And so they've got this big pile of cash, and they look around and they see projects and they say, okay, well, we don't think these marginal projects are going to pay off, especially with this push to phase out oil, and it's going to take us 10 years to pay back on this. So it makes more sense just to buy our shares back. And I don't know why we would try to handcuff them. We don't prevent a company from taking taking itself private. We didn't try to say, well, Twitter, you can't sell all your shares and take that company private. We don't tell companies like that what they can do, and that's why I think the criticism of the share buybacks is misplaced. But I think Chevron, they've got a lot of money because oil prices went up a lot last year, and share buybacks is a reasonable place to put some of that money.
So based on your article with the predictions for 2023, do you think then that the oil service companies, if the US is going to actually grow oil production and companies like Schlumberger are going to be substantially raising prices? I think they said they might be raising prices by 20%. They already had increased prices a little bit before that, but they're raising prices again. So do you think then that the oil service companies are kind of going to be the potential outperformers in the oil sector for 2023 then?
I mean, anytime you see a sector raising prices like that, they believe they can get it. They believe the demand is there. So definitely, when somebody's strongly raising prices, that's a good sign for them. Like Chevron and ExxonMobil, they didn't raise prices last year, but prices got raised for them, and they profited immensely. And if the oilfield services companies feel like demand is high enough that they can justify raising prices like that, yeah, then you could expect them to perform very well this year.
So if oil and natural gas prices are relatively weak this year, do you expect dividend cuts from some of the higher cost producers who are using debt? So probably not Chevron, ExxonMobil dividend cuts there, but maybe some of the other companies.
Even still at $70 oil, most of those guys are doing okay. They kind of tightened their belts back when oil hit $20-$30 back in 2014, 2015. And if they survive that, they've learned to be a little bit more careful. And so, $70 oil is still a lot better than where they were. I don't know anybody who's losing money at $70. So I'd be surprised if we see many dividend cuts. Certainly, Chevron didn't even cut their dividend when COVID sent oil prices into negative territory in 2020. So Chevron definitely not going to cut their dividend. ExxonMobil will not. Shell did cut their dividend a couple of years ago, and I don't think they should have then. And they broke a streak that had been in place since World War II, they took some criticism for that. But I don't expect we'll see anybody else cutting dividends, and maybe some small, but most of the small, the higher cost producers, they're not paying dividends anyway.
Well, you also had over the last 12 months, you had some of these independents of the smaller producers, the mid-tier producers. They announced not only a base dividend, they announced a variable dividend. So 20%, 30%, 40%, for example, of their free cash flow, they're willing to pay out in dividends. So I think the variable dividends will be cut. But yeah, as of now, I don't think we're there yet. But I think a lot of it is probably dependent, Robert, and we'll talk about this a lot, about the natural gas price, because a lot of these companies over the last, and you've been in the oil and natural gas industry for a long time, the production mix has changed a lot over the years. So it used to be that natural gas was flared off, it wasn't stored. The production mix used to not be 50-50 for a lot of these companies, or close to 50-50 for 50% of revenues for oil or natural gas, a mix of that. And now a lot of these companies are close to 50-50 or 60-40, somewhere along those lines. So do you expect then, if the natural gas price stays low for a while, then that will potentially affect free cash flow and dividends?
Yeah, of course, because that is a substantial portion of some of these companies, like ConocoPhillips. That's a major component of their earnings and their cash flow. So it's going to be tough if natural gas prices stay low. But still, it's relative. A few years ago, natural gas prices broke below $2. So we're still doing a lot better than that. And LNG exports are going to keep growing, and there's the markets in Europe are going to keep growing. So I don't think it's going to collapse like it did, a few years ago.
And we're at, I think, $1.83 now in the Haynesville that they're getting at the wellhead for natural gas. So it's way down over the last 8 weeks compared to what it was. So I don't think this is sustainable in an environment where the oil service companies and the drilling companies are raising prices. So in the short term, yeah, natural gas can be weak, but over the next 6 to 9 months, couple quarters, the price is going to revert a lot higher, especially if costs to drill new wells or replace existing wells are going up.
Yeah.
Also, I don't know how much you pay attention to this. How much are these natural gas producers, a lot of them hedged? So did a lot of them re-hedge? I know 3, 4, 5 years ago, some of them hedged at $4 and those hedges came off, but did a lot of these natural gas producers in the US and Canada, did they re-hedge at 6, 7, or 8 a couple months ago?
Yeah, I don't know. I mean, I don't agree with hedging. I subscribe to ConocoPhillips philosophy that, over the long run, hedging it just is an extra cost of doing business, and we would rather just, float up and down with the price and not pay that extra cost to have to hedge. And so ConocoPhillips doesn't hedge, or at least they hadn't hedged, and so I don't really know. I don't know who's hedging and who's not, but I think in the long run, hedging will eat into earnings over the long term, even if, over the short term, it might be benefit and it might hurt you.
And there's also the human component. I mean, a lot of these companies, Lynn Energy went bankrupt years ago from bad hedging.
I was thinking about them. I was actually thinking about them as I was talking. They like to hedge a lot.
Yeah, I remember back in the office at Investing Daily in 2013, I think it was around there, where they had enormous problems. So, I mean, there's tons of examples of this where human beings think that they can hedge price as well. And then we're just seeing it in the disclosures for a lot of these companies that they're writing off enormous losses, whether it's a mining company or an oil and natural gas company. There's just losses on either foreign currency hedging or energy hedging or other inputs. There's just a lot of problems.
Well, that's what the Biden administration is trying to do with the Strategic Petroleum Reserve. They're trying to hedge. They're trying to say, hey, we don't like prices at we don't want to pay $75 a barrel to refill this. We want a better price than that, and they're trying to play in the commodities market here to refill the Strategic Petroleum Reserve. And I had an interview this morning. I said, there's no guarantee that oil prices are going to keep going down, and they may go back up. And if they do, what are they going to do then? They're going to sit there with a depleted Strategic Petroleum Reserve, which increases our risks if we have a true emergency. And if we do have a true emergency, it's going to look like one of the stupidest moves in the history of presidencies. I mean, it's going to be a very, very stupid move if we need that oil and it's not there because, they depleted it last year to try to combat high oil prices, and they wouldn't refill it this year because they didn't think the price was low enough.
Well, also, they were using the oil for Strategic Petroleum Reserve to try to help the Democrats in the election for lower gasoline prices, because the existing party is normally blamed, whether it's in Congress or the White House, is blamed for inflation. So even if both parties help create the inflation over past regimes, which I would argue both parties did help create a lot of the monetary inflation that was created and supply chain issues and shutting down businesses and stuff like that, both parties were heavily involved in that with policy blunders. But the Democrats were in power leading up to the elections, and so he wanted to lower gasoline prices to try to help buy votes in the November elections. But that's not the purpose, the stated purpose, at least, of the Strategic Petroleum Reserve. It's supposed to be there for emergency, for national security purposes.
Right. It's been used politically again and again and again, but that is not the purpose. I heard somebody say this morning, it's not the Strategic Political Reserve, and that's the way that it's often used.
Yes, unfortunately, yeah. The same thing with ESG spending. The Department of Energy has become heavily politicized. So whichever party's in power in Congress or the White House, the pet projects for spending at the Department of Energy here in DC, it just switches. So whichever type of energy the political party that's in power decides they want to start allocating capital to, then policy just changes drastically, and you start seeing more and more capital allocated towards that new form of energy spending.
Yeah.
Unfortunately for forms of energy like nuclear power, you need long lead times. So you need multiple regimes over multiple long periods of time to commit to something like investing in nuclear power and new types of research and development for these small modular reactors, or even to build one of these big nuclear power reactors. I mean, you have to commit 10, 15, 20 years to it and over $1 billion.
Yep.
And it's unfortunate. So we don't have either party. It's like pulling, it's a nightmare just to get one or two new nuclear power plants built here in the United States.
Yeah, right.
So I want to,
we need some more, and China's building them like crazy, and that's the right thing to do. But yeah, we need some more ourselves.
yeah, and that's really to alleviate for our manufacturing base with cheaper electricity. Although I would argue the U.S. has an advantage for our potential manufacturing because we have such cheap natural gas compared to the rest of the world.
Yeah.
So I actually want to ask you about cheap natural gas. I know you were researching this since I was emailing you over the last week to 10 days. We were supposed to have another interview, and thankfully you were able to look this up. What are some of the lower cost natural gas producers in the US and Canada?
So I think EQT is one of the lowest, and so I pulled up their latest quarterly report, and they break it down dollars per thousand cubic feet, which I think is about the same as dollars per million BTUs. And they said their realized price that they received was, where did I see that? Well, they said the total unit operating cost is $1.33 per thousand cubic feet. That was their cost of production. Their average sales price was $3.19. So operating cost of $1.33, sales price of $3.19. But then they break it down into components, and gathering was the largest cost. It was 65 cents per thousand. And all the pieces, like they got production taxes of 6 cents and processing of a dime, transmission of 30 cents. And it all totals up to operating costs of $1.33. And then they got production depletion on that of 85 cents. Those numbers are the operating costs are 2 cents higher than they were the year before, so it's pretty consistent. And production depletion was 5 cents lower than it was the year before. So that gives you some idea of what it's costing them to produce and transmit to end users.
So they're mostly at EQT. I know they were doing a lot of acquisitions the last 12 months. I think they bought over $5 billion worth of new assets in West Virginia, Pennsylvania, the Appalachians. They're in the Fayetteville shale gas patch.
They're big up in the Utica and up in that area, up in the Appalachian Basin. They're a big producer up there.
Is that considered one of the lowest cost areas?
Yes. Yeah. It's probably the lowest cost area in the country, I think.
Yeah, it's too bad. It's too bad the Northeast, like Massachusetts, I know they're importing liquefied natural gas because they're not approving pipelines and are not importing. I mean, it's right there. They could easily just build some pipelines and move that natural gas up to Massachusetts. Instead, the poor people in Massachusetts, and I mean, poor people like their politicians and bureaucrats are not making smart policy. Instead, they're importing liquefied natural gas from across the Atlantic.
Yeah, we do some crazy things in the name of energy policy. I mean, we really do a lot of things that don't make any sense.
So EQT still has pretty good profit margins then, if they're the lowest cost producer. I mean, even at current natural gas prices, we've rallied a little bit today. We're at just under 2.6 for natural gas. So are they getting, do you know if they hedged at a much higher price, say at 4 or 5?
Yeah, I don't know about their hedging. I do know that their share price at one point last year was up like 150%, but it has pulled off. It's they hit a high of about $50 in September, but they're down to about 30 now. And I did recommend selling a put on EQT for my investment newsletter a couple of months ago. I recommend selling a $27 put. So we're in the money on that, and that's about to expire profitably. But we may turn around and sell another one because at this price at $30, I think it's a pretty good deal, and you're further hedging your downside if you're selling a put on it. So we may do another one here. We make annual returns of above 10% on these puts most of the time, and I think we were up in 15% on that one.
Yeah, I think for the next couple quarters, natural gas prices are going to be weak, and then I think the market's probably going to correct, and we're going to have a big rally in the not too distant future. I don't think it's sustainable with rising drilling costs. I mean, long term, electricity demand, natural gas demand, liquefied natural gas demand, it's still strong. We've had a temporary cutback in natural gas usage, mostly out of the European Union and the United Kingdom. They've shut down their fertilizer plants. You have politicians and the bureaucrats talking about ways that they need to use less electricity, use less energy, which means temporary cuts in natural gas. But I don't think long term that that's going to hold.
Yeah. And I just checked the put. So we sold a $27 put that expires in March. That's a 13.2% annualized return on that put. And right now we're looking in good shape on that one. I mean, it could go down and we could get a sign, but that looked like a pretty good risk reward to me at the time when we sold that.
Yeah, some of the larger liquefied natural gas exporters like Cheniere Energy, I mean, they were inking a lot of long-term contracts. I think they got another large one done in the last couple months with one of the Chinese oil companies. So they just keep getting more and more contracts, it seems, and these are locked in at long-term prices, good long-term prices.
Yep.
So I want to get your opinion here on if your thesis for 2023 for weaker oil and natural gas prices plays out. What do you think investors should they be more defensive than in the last couple of years if they're going to allocate capital then to oil and natural gas? Should they be looking for safer income plays, pipeline companies, oil services? What do you think would be potentially the top performers in the oil and natural gas space?
Yeah, I've been telling people to play it cautious, and back to my covered calls and the puts and stuff. I've been selling covered calls close to the money for the energy sector now for the last 3 or 4 months. And for those that don't know, if you believe that prices are going to go down or there's downside risk, you keep it close to the money and you get more money in hand. And I've been doing that for several months. And I would recommend people be very careful. Stick to the quality companies. I definitely wouldn't go with any high rollers here. Pipeline companies are always popular. I own Enterprise Products myself, and I recommended Energy Transfer a while back when I thought the price had bottomed out. Magellan Midstream, a lot of those guys are not very exciting, but they do crank out consistent cash flow. Chevron still, but Chevron's gotten a little pricey. I'd try to pick at it, maybe open a covered call to knock a good chunk out of the purchase price. That may be a way to go in and open a position there. And the Exxon Mobils and BP, of course, and Shell. ConocoPhillips, I own that. Some of and as you say, the oilfield services, I don't follow those as closely, but with all these price increases, that may not be a bad place to be. But I haven't tracked how they performed as a group last year. I haven't really looked at those in a while to see how they fared.
What are your thoughts on some of the Canadian producers like Suncor? Because I know they've been doing a lot of acquisitions lately. I mean, they've been in the headlines. They've just been buying up more and more assets around their current assets lately. So it seems like they're starting to accumulate and grow and build market share up in Canada.
Yeah, in fact, it's funny you mentioned Suncor. I did a trade on Suncor a few months ago. I opened a covered call on Suncor, and we're in the money on that one. Suncor at the time was the top-rated company on my stock screens for just about any company, but for any energy company, it was ahead of everybody else at the time. And one of the reasons was the price was a little depressed when I opened it up. But Suncor is a good company. Who else up there? I think that's not the only Canadian company that we've got
I think there's Canadian Natural Resources, but I think there's been quite a bit of merger and acquisitions though. So there's rumors swirling that like some of these, I know there's a ridiculous rumor going around that ExxonMobil or Chevron might buy BP, but I don't think they're going to want to deal with the pension funds and the government in the UK trying to get that merger approved. So I don't think that'll happen.
So I wrote a few years ago that makes sense for ExxonMobil because ExxonMobil had an exploration cost and a full-on cost that was greater than the assets that BP had on their books. I mean, BP had oil on their books, and BP's share price was so depressed at the time that I made the argument that ExxonMobil could drill for oil cheaper by buying BP than they could going out and exploring for it. But it's as you say, there would be a lot of government pushback. BP is the pride of the UK. I think you'd get a lot of pushback from the UK and resistance there. It would be hard to do, but it would make sense. And the only ones that could do it realistically are ExxonMobil or maybe Chevron. Shell could maybe do a merger with them, but ExxonMobil, Chevron could potentially buy them out. But I don't think it'll happen.
Yeah, I agree. I think if it was just free market and capitalism and there wasn't all this government rules, regulations, red tape involved, I think the business combination would make a lot more sense. But because there's all these extra regulatory hurdles and approvals and antitrust divisions and the pension funds that control the dividend allocation for BP, and you'd have to get their approval too, I don't think it will happen.
Yeah.
So I want your opinion then on the different estimates for oil demand growth, because I think BP actually, shockingly, in their statistical review, they're actually projecting that oil demand growth long term will start to taper off. So where do you view on that? What are your views on that?
I think that's accurate. I mean, I think oil demand will taper off, but a lot of it depends on China. There's all this talk that China is opening back up, and if their oil demand growth over the past 10, 15 years has been extremely strong, and since COVID, that's kind of flattened off. But if they get going again, they will drive oil demand globally. Even though we may see the U.S. continue to flatten or decline, and we may see the European Union do the same. China and India may more than offset that. So, a lot of it just hinges on China. I think electric cars will continue to take some market share away, but it takes longer than people think. And, Bloomberg published a report in 2015, I think, where they were suggesting that electric vehicles could take 2 million barrels a day off the oil markets by 2022. And I said, that's preposterous. I mean, there was no way that was going to happen. And I wrote a rebuttal and said, here's why it's not going to happen. I mean, demand growth is going to be probably more than that. So you're going to be 2 million barrels a day higher than 2015, not lower. And that happened. You did not see, you haven't seen electric vehicles take big demand. One of the reasons is the turnover in the car market is so slow. Even as some of the countries that have had the strongest penetration of electric vehicles in the world have not seen these dramatic decreases in oil demand, like Norway, for instance.
Well, and Norway also they increased oil and natural gas production. They were taking advantage of those much higher liquefied natural gas prices in the European Union and the UK, especially in Germany. They were exporting a ton of liquefied natural gas to Germany.
Yeah.
But I think one thing that people are missing is that if electric vehicle replacement for regular internal combustion engine cars that use gasoline or diesel, if that does occur, I mean, that's still going to use a lot of electricity. It's still going to you're either using more coal or you're using more natural gas, probably, unless a lot of new nuclear power plants are built. But as we discussed earlier, the majority of nuclear power plant growth is only in China.
Yeah, there's going to be a bottleneck here, I think, in the grid and in the ability to produce enough electricity. I mean, the faster you ramp up the electric vehicles, it's correct. This is going to be a major driver for the electric utility industry, though, going forward. I mean, they haven't seen a lot of growth in recent years, but they are projected to see, growth driven by electric vehicles. So, it's probably not a bad time long term to be in an electric utility.
The other part of that is that there's a lot of articles that are coming out lately that are finally highlighting this, that there's not enough copper. So if we're going to replace millions of cars on the road, internal combustion engines, with electric vehicles, each electric vehicle uses many, many pounds more copper than a regular internal combustion engine car. So there's just not enough copper right now. We'd have to increase the copper supply from the annual mine supply massively.
Yeah, that's one of my investments is Rio Tinto.
Yeah, they're
been weak. Major copper producer.
Yeah, and also iron ore and base metals. So with China being weak and China being offline, the base metal companies have not done well lately, especially because a lot of that was tied to the China housing development and fixed asset boom and now bust. But long term, yeah, I mean, if the costs for mining and the grades are falling, if the costs are rising, and all these costs are up enormously for a lot of these mining companies, it's not that the commodities supply side is going to be have very serious issues in the next couple of years with falling grades and rising costs.
Yeah.
So as we wrap things up here, actually a surprising thing that you have in your predictions for 2023 is you actually are predicting that you think solar will be the top performer for energy in 2023. So why do you think solar is going to be the top performer?
Well, I mean, if you look at the growth and solar has, until the last couple of years, solar had dramatically outperformed oil and gas over the past decade or so. And I've got several solar investments, and I felt like last year they would continue to do well last year, but they got kind of dragged down with the whole tech sector. And so my prediction was that the Invesco Solar ETF TAN would return 20% last year, and in August or so it was up 18 before pulling back at the end of the year. And my prediction again this year, I doubled down on it. It's just like I did with ConocoPhillips before. In 2020, I predicted ConocoPhillips would return 20%, and then COVID hit, and it ended up being down sharply. And the next year, I just doubled down. I said, I still think ConocoPhillips is poised to do well. And I predicted that it would return 30% in 2021, and it did more than double that. The Invesco Solar ETF, I'm just looking at it. It's already up, 9% year to date. I think it could be a very good year if solar gets back on track this year. It just, it took a break last year, but long term, solar has been very, very good investment. And I think the solar growth rate will continue to be very high for a very long time.
Is this an ESG play because your thesis is that governments are going to force these utility companies, electrical utilities, or maybe even ExxonMobil, Shell, Royal Dutch Shell, BP, Chevron, those guys, the large big oil companies, to allocate more of their capital to things like solar or wind, ESG type?
Yeah. I mean, it's definitely an ESG play. I don't think solar would be nearly where it is without, all the government rules and regulations shoving investors are shoving, the industry in that direction. But it's global. I mean, you got China going gangbusters in solar, and you've got Chinese companies that are producing, solar panels and silicon wafers doing very, very well. And so I think it is an ESG play, but it's worldwide. So I think even if the U.S. suddenly tomorrow said, hey, we're not going to do this anymore, I think solar still has a very bright future.
And do you think the Republican Congress will be able to force the Biden administration to refill the Strategic Petroleum Reserve? Or do you think that it's mostly just all talk and rhetoric then?
Yeah, I don't think they'll be able to force him to do it. There's going to be a lot of pressure on him to do it because it's like having a house with insufficient insurance. You got a house that's worth, $500,000 and you're only insuring it for $100,000. And that's kind of the way we're going here. Most of the time you might get away with that because most of the time there's a disaster doesn't befall your house. But if your house burned down and you are sufficiently underinsured, it's going to be a financial disaster. And if we went to war with China or somebody and our energy got disrupted, and we're sitting there with a depleted Strategic Petroleum Reserve, it's going to look like the dumbest move in the history of presidencies. I mean, it's going to look incredibly stupid in hindsight that, they played games with the Strategic Petroleum Reserve.
I think you're more optimistic than other people I've spoken to. Some of the people I've spoken to tell me that they don't think the Strategic Petroleum Reserve will start buying again until at least 2024, until there's someone else in the White House.
Well, I think that's probably accurate. I think that he will push this off to somebody else, and we will cruise along with a very low Strategic Petroleum Reserve, and it's just a big risk that we're taking. So he might get away with it. And again, if he gets called on the bluff here, it's going to be a very, very problematic thing. And long-term history will not be kind that we played games with the Strategic Petroleum Reserve. But I think you're right. I think he's going to kick the can down the road, especially if oil prices don't substantially fall. He's going to keep kicking the can down the road and just push it off on someone else to deal with.
Maybe we should have a strategic natural gas reserve. I mean, there's not enough natural gas pipelines in the United States. I know we're building some more, but it's tough to get some of these things approved. Oh, I was talking about the storage tanks. So there's just not enough storage tanks for natural gas. I mean, we flared so much of it. I think I read an article recently that they started flaring off some of it again in the shale patch. So instead of flaring off this gas, I mean, for infrastructure play, Robert, we should just build these giant storage tanks and have a strategic natural gas reserve instead of just flaring it off.
Well, they do have pretty massive caverns that they store up for right from about April, May. It starts injection season, and they fill these caverns up all through the spring and summer, so that they pull them down during the winter. So there is pretty massive storage already, but it's not strategic. It's just for seasonal.
Yeah, I think that would be a smart infrastructure play. So building more liquefied natural gas import and export facilities, building new storage tanks, investing in nuclear power, multiple long-term regimes committing to things like that, and then investing in next generation nuclear power, that would be smarter. But as we discussed a couple of minutes ago, DC, whether it's a strategic petroleum reserve or the debt ceiling, I mean, the interest payments on the debt are insanely high now that the Fed is raising interest rates. I mean, DC, both political parties are just really good at pushing things back and kicking the can down the road, unfortunately.
Yep.
So, Robert, if my listeners want to follow your work, take a look at your newsletter, your Forbes column, how do they do so?
So I always tell people, just the easiest way is just Google my name and Forbes, and you'll find my Forbes columns, or Google my name and Investing Daily. And I write 3 investment newsletters for Investing Daily, and I also publish a free column there every Tuesday, just on general personal finance stuff. But there's always links there to my newsletters as well.
So last question before I let you go. If the natural gas price stays low and costs go up, we're going to have a good amount of natural gas producers producing at a loss if they didn't hedge smartly, which the odds are pretty low considering human behavior and how badly a lot of these companies screw up on their hedging programs. So do you expect 12 to 18 months from now, maybe 24 months, that the natural gas price will have a substantial rally again?
Oh, yeah. I mean, the cure for low prices is always low prices, and vice versa. I mean, that's why the oil and gas industry is cyclical. Every time prices get too low, people cut back on investments and they cut back on production, and then that ultimately leads to an undersupply situation, and the price rebounds, and we go round and round.
Well, I also think that China, since they sold a lot of their liquefied natural gas that was on a tanker 3-4 months ago to Germany and the European Union at sky high prices, they're going to start buying a lot of that natural gas back at these low prices, and they're going to start taking deliveries soon if they haven't already.
Yep.